So you're thinking about getting into the stock market, huh?
That's great.
Well, it can definitely feel like everyone's speaking a different language, right?
Oh, yeah, absolutely. Like all these terms and jargon, it can be super overwhelming.
That's why we're doing this deep dive today, to break down the most important terms you need to know in the stock market.
Yeah, so you can make sense of it all and feel more confident in your decisions.
So you're not just throwing money at something you don't understand, right? We're going to keep it focused and efficient because we value your time.
Absolutely.
So let's start with the very basics. What exactly is a stock?
Well, you can think of a stock or a share. It's basically like a tiny piece of ownership in a company.
Like a slice of pie.
Exactly. Like if a company is like a big pie, a stock is one little slice of that pie.
Okay, got it. And what about dividends? I hear that word thrown around a lot.
Dividends, those are like little bonuses that companies give to their shareholders.
So if the company's doing well,
Yeah, if they're making a profit, they might decide to share some of that profit with the people who own their stock.
okay, that makes sense. So what about all this talk about bull and bear markets? What does that even mean?
Okay, so a bull market, that's when the stock market is generally going up.
Like a bull charging ahead.
Exactly.
Right.
Prices are rising, people are feeling optimistic, and it can kind of create this upward momentum.
A bear market is the opposite.
Yeah, a bear market, that's when prices are generally falling. There's more pessimism,
Yeah.
and things are trending downwards.
Makes sense. So like bull market, good, bear market, not so good.
Yeah, it's a pretty good way to think about it.
And when you hear about a company going public, what does that actually mean?
That's when a company has its IPO or initial public offering.
IPO.
Yeah, it's basically the first time a company's stock becomes available to the public for anyone to buy.
So before that, it's like a private club.
Pretty much, yeah.
Yeah.
And then they go public and open it up to everyone.
Got it. Now, what about ETFs? I hear that a lot these days.
ETFs, those are exchange traded funds, and they're really popular right now.
They sound kind of complicated.
They can seem that way, but actually they're pretty simple. Think of an ETF like a basket of different stocks.
So instead of buying just one company's stock,
Yeah, you're buying a bunch of them all at once.
like a diversified portfolio in one package.
Exactly, and they trade on the stock market just like individual stocks.
Interesting. And how are they different from index funds?
Good question. So an index fund is a type of ETF or mutual fund that tracks a specific market index.
Like the S&P 500.
Yeah, exactly.
Gotcha.
The S&P 500 or the Dow Jones Industrial Average.
So if the S&P 500 goes up, the index fund goes up too.
Pretty much, yeah. It aims to mirror the performance of that index.
Okay, I'm starting to get the hang of this. So once I've bought some stocks, ETFs, maybe some index funds, what do you call all that?
That's your portfolio, your collection of all your investments.
Ah, like an art portfolio.
Yeah, but instead of artwork, it's your investment.
Got it. And what about asset allocation? What is that all about?
Asset allocation is how you decide to divide your money among different types of investments.
Like how much do I put in stocks, how much in bonds, how much in real estate?
Yeah, exactly. It's about spreading your risk and making sure you're not putting all your eggs in one basket.
Makes sense.
Yeah.
So now we're understanding what we can buy, but how do we actually evaluate a company? Like how do we know if it's a good investment or not?
Right. So there are a bunch of different metrics and ratios you can look at.
Okay, give me the rundown.
First, you've got market capitalization,
Which is,
basically the total value of all the company's outstanding shares.
okay, so like the bigger the market cap, the bigger the company.
Generally, yeah, it's a way to get a sense of the company's overall size.
All right, what else?
Then there's earnings per share, or EPS for short.
EPS.
Yeah. This tells you how much profit the company made for each share of stock.
So the higher the EPS, the better?
Generally, yeah, it means the company is more profitable.
Okay, and what about the PE ratio? I've definitely heard that one before.
The PE ratio, that's the price to earnings ratio. And it basically tells you how much investors are willing to pay for each dollar of the company's earnings.
It's a little tricky.
Yeah, it can be, but basically a high PE ratio could mean that investors are really optimistic about the company's future growth.
Or it could mean they're just paying too much.
That's also possible, yeah. It's not always a clear-cut indicator.
So you have to look at it in context.
Exactly, along with other factors.
Okay, what other factors?
Well, there's the debt-to-equity ratio,
Which tells us what?
how much debt a company has compared to its equity.
So a high debt-to-equity ratio is a bad thing.
Not necessarily, but it can be riskier because it means the company has a lot of debt to pay off.
Makes sense. And what about ROE?
ROE, that's return on equity.
Ah, okay.
It measures how effectively a company is using its shareholders' investments to generate profits.
So a high ROE means the company's doing a good job with its money.
Yeah, basically it shows they're efficient and profitable.
Okay, so we've covered a lot of ground here. Anything else we need to know about the stock market?
Well, we should definitely talk about volatility.
Volatility.
Yeah, it's basically how much a stock's price fluctuates up and down.
So a volatile stock is going to be like a roller coaster ride.
Pretty much, yeah. The price can swing wildly from day to day.
Okay. And how do things like interest rates and inflation affect the stock market?
So interest rates, those are set by central banks, and they can have a big impact on borrowing costs for companies.
So if interest rates go up, companies have to pay more to borrow money.
Exactly, and that can affect their profits and their stock price.
And inflation.
Inflation, that's the rate at which prices for goods and services are rising.
Say everything gets more expensive.
Yeah, and that can erode the purchasing power of consumers, which can also impact companies and the stock market.
Makes sense. And last but not least, what about expense ratios?
Expense ratios, those are the fees that you pay to invest in mutual funds or ETFs.
Okay, so it's like a management fee.
Yeah, you're paying for the fund managers to manage the investments.
So the lower the expense ratio, the better.
Generally, yeah, it means more of your money is going towards actual investments.
Okay, so we've covered a ton of information today. Just to recap, we talked about stocks, dividends, bull and bear markets, IPOs, ETFs, index funds, portfolios, asset allocation, market capitalization, EPS, PE ratio, debt to equity ratio, ROE, volatility, interest rates, inflation, and expense ratios.
Wow, that's a lot.
Yeah, we really did a deep dive
We
today.
sure did.
But I think it's important to understand all these concepts if you want to be a successful investor.
Absolutely.
And now you have the basic vocabulary to start navigating the stock market with more confidence.
Exactly.
So think about it. Which of these concepts really sparked your interest? Which ones do you want to learn more about?
That's a great question to ask yourself.
And if you found this deep dive helpful and you want more clear and concise explanations of important topics, be sure to subscribe to our YouTube channel and hit that bell icon so you never miss out on our future deep dives. Your support means the world to us and helps us keep bringing you valuable insights.
So thanks for tuning in.
We'll see you next time.